I'm going to start with a couple of key sectors or key indicators that we look at and where we see the strength. I mean, we're looking at the strongest economic growth that we've seen in almost 40 years. And it's due to the way that the fiscal stimulus came in and supported the shutdown and got us restarted. The strength's going to basically come from three sectors in the economy. It's going to come from consumer spending, which we're going to look at here, housing, and manufacturing. So let's start with retail sales here. And you can see at the right side of the chart, the huge dip when they shut down the economy. You couldn't spend money because nothing was open. But how fast that black line came back up, and actually we are ahead of the trajectory we were on in retail sales. So that's a positive. So not only were companies allowed to remain open, but people had money to spend. Some of it came from the stimulus.
I think a lot of it came from the stimulus.
It definitely did. So that helped support retail sales. I think another thing that played really well into here, if you go back 20 years ago, who was buying things online?
Not me.
Yeah, no, hardly anybody. 10 years ago, not even a lot of people.
Right.
But over the last 10 years, the Amazon, the online shopping, the eBays, those companies, the ability to buy something online, have it delivered to your house, allowed you to go and spend money even though stores were closed.
Yep.
So it was an interesting time that we were going through, and you could see it here in the recovery in retail sales, and we project that to continue to be strong. Building permits. I believe everybody out there by now knows how hot the housing market is around the country. Even in Michigan, we're seeing it. How there's not enough supply out there for the demand, and new building permits is what this is measuring. If you look at the very right side of the chart, we are way up there over the average and basically maintaining a strong market for new homes. That is great for the economy because home building is such a big part of the whole economy, right from the supplies of material through the labor needed, all the way through. So we're seeing a continued strong housing market as it relates to new permits coming into the building sector. Also, manufacturing. Again, on the very right side of the chart, looking at what's happened from 2020 to 2021, we are way above the average in manufacturing recovery. Why is manufacturing so high? Because people have the money to spend and they could buy things online as opposed to have to go to a store when the economy was closed. So very strong continued growth in manufacturing through March, as you can see here. So
now,
if
they could just manufacture the chips for the cars, they could probably sell the cars that are sitting in the lots waiting for the chips.
Yeah, and that's actually part of what's keeping, I think, inflation down, because when you shut the economy down, there's such disruption in the supply chain.
There is.
And we don't have a smooth supply chain yet. So this is going to be up and down for a while, but the opportunity for growth is out there, and they're going to fix those things as we move forward. So again, talking about where we see inflation going here in the rest of the year. Short term, the red line is showing you what we believe is going to happen. This is a year over year change in inflation. And you can actually see, looking at that blue line on the left side of the chart, how it kind of looked like it was actually going down in 18 and 19. But then in 2020, we had the drop due to COVID and things shutting down, an immediate bounce back, and then a leveling off. But now that we've got the vaccine, now that a high percentage of people are getting or have been vaccinated, and there's also more herd immunity out there than there was obviously a year ago, as more people have recovered from COVID and now have the antibodies. The demand is going to stay stronger than the supply because of the disruptions in the supply chains. So we expect that to cause a short-term, pretty significant increase in inflation. However, we don't believe that's going to continue for the long term, because once the supply chains get filled back up, we think things are going to moderate. But expect it, for the next half of the year, that we're going to see a little increase in inflation moving forward. Another thing we look at, and I apologize, these are very unattractive charts, but they tell the story, and this is how our analysts are looking at it. When you look at this one, the black dotted line represents the 30-year average of the consumption rate in the United States and how they measure inflation. It's been an average of around 1.9%. Okay, that's the black dotted line in the chart. You look at where we're at right now, is 1.6 is the blue dotted line, the 3 dots there. We're actually still way under the Fed target. And as Dan said before, you actually have to have higher inflation than average to somehow settle back into an average. So we're going to see that short-term spike way above, 2, 3, 3.5% inflation increase here in the second half of the year, but we believe it will moderate. And remember that the stock market is always forward-looking, so it's pricing in this inflation right now.
Yeah.
So it's not like we're going to expect a huge change in the stock values over the long term. Yes, short-term volatility, because inflation, you're going to hear inflation numbers that are going up. So expect the volatility on the daily basis, but we still believe long-term, things are moving forward and we see the economic growth. So we went through 3 of the sectors of leading economic indicators. This is our chart that we show of all the speed dials, the 20 different areas that we look at to determine if we're moving forward, if the economy is expanding, looking forward, or we see some places where there's got some negatives. And if you remember us showing this chart before, a year ago, we had a lot of red on this chart. And again, how you read this chart is if it's green or green-blue dials, that means it's a positive trend. If it's yellow, that means it's kind of neutral, not necessarily moving forward or backwards, but maintaining. And then obviously red would be negative, but there's no red on this chart. And that's just amazing how strong the indicators are signaling that we have an even more entrenched and durable recovery coming out of the COVID crisis. So we believe that this is signaling the second half of 2021 is going to continue to be strong for the markets and the economy moving forward. And I want to go over kind of how we measure the gross domestic product, GDP, and what we see from a forecast standpoint. We're still right on target from what we've been showing earlier in the year. If you look at the middle of the chart here, the middle of the slide, the potential GDP growth range, look how bad it was in Q2 of last year. We were down 31%. However, due to stimulus and being able to do online shopping and things like that, Q3, we had a great bounce back of 33%. Q4 moderated to about 4%. And the Q1 of this year, very strong, we believe is going to come in somewhere between 4 to 6%. However, when you look at the right side of that line, the annualized 2020 growth of the economy actually stayed negative.
Yeah.
Because it was such a hard shutdown. But look what we're forecasting for this year and next year. We're going to be somewhere between 5 and 6.5% in growth in the gross domestic product, or the production output of the United States. And we still see it strong in 2022, somewhere between 2.5 and 4.5%. So if you think traditionally, Dan, over the last 30, 40 years, a 2.5% growth rate would have been considered a fairly strong market and economy that gave us a 6 to 7% annualized rate of return on a 60-40 portfolio.
Right,
it did very well. So we see that for the future. However, there is going to be volatility due to disruptions in supply chains and rising interest rates as a result of demand exceeding supply in the short term. And I'm going to wrap up with this. So what do we think is going to actually the market's going to look like towards the end of the year? Well, based off of what we're seeing at the end of April, we're forecasting U.S. growth to moderate, because it's above 10% right now, to moderate and be somewhere between a 6 to 10% annualized growth rate. Dividend income stocks, your value stocks versus growth stocks, same thing. They've come back really strong this year versus growth. They were a little bit behind. Here again, mid cap and small cap stocks has a little bit higher opportunity, again, because they didn't go out of, as many didn't go out of business in the shutdown because the government helped prop them up. We see strong recovery and continued growth in the small and mid cap range. The negatives we see, as Dan alluded to earlier, is the developed markets. Again, they're having issues with COVID, much greater than we are, and they didn't put the stimulus that the United States, the monetary policy didn't act as fast as our government. So they're not seeing the economic turnaround as fast as we are. However, emerging markets in Asia, we expect to see strong growth, and it's not really kicked in a whole lot yet, but we believe in the second half of the year, as the US economy recovers, they're going to be coming back gangbusters in the second half of this year. The middle of the chart, taxable and tax-exempt core fixed income, is still going to continue to be negative. And even though it's coming back, these numbers were down in double digits. We expect them to end down about 1% to 2%. And you're saying, well, then why would I have a mixed portfolio of stocks and bonds? Because what we do is continue over to the right, look at the opportunistic fixed income. In the tactical area of corporate bonds, high yield bonds, things like that, we're expecting to have a high rate of return of 5 to 7% in those areas. So we shift a little bit away, we underweight core fixed income and overweight opportunistic fixed income in your portfolio on the bond side. And then also, you have to have the alternatives in there. You saw that how gold was down, but it was showing signs of coming back. Commodities, same thing. Commodities are going to be strong as a result of the short supply, lumber, corn, things like that. Still, the supply chain disruption is causing those to have to ramp up. And so we see opportunity in growing there until that supply chain gets filled back up and we're more normalized in our growth. And how does that equate to the balanced portfolio all the way on the right? We're looking at a gross rate of return of somewhere between 6 to 8%. So I do not see that as a bad year at all. But do remember, we keep saying volatility is here because of disruptions in the supply chain. So you're going to hear, oh, this is a shortage, or you're going to hear the raising interest rates. Those things are going to go on, but always take the long view when looking at your portfolio. And we see that light at the end of the tunnel, and we're planning for that moving forward. So that's kind of my stuff, my area, and I'm going to bring Dan back on. We're going to talk about the opportunities and wrap things up. So
absolutely.
Any other points on that, Dan?
Well, it's just when you're looking at the market today, and you look at where the growth is, and I can't stress this enough for people who are long-term investors. You just can't bounce around from one place to another trying to chase the returns. You've got to be very strategic in what you do. And you've got to be methodical, and you've got to be patient. Patience is really, they say patience is a virtue. Well, in investing, it is critical, because if you can stay the course, you will get the returns that you're looking for. Yeah. And we're seeing that with clients today. Yeah. Was there a little bit of volatility in the last couple of years? Absolutely. But do the returns reflect a very solid, on-target, goal-oriented return? Absolutely, and people are getting exactly where they want to go. So it's diversification, like you said, and it's just staying the course. So I see a lot of good things for 2021, and it's like we say, it's short of another black swan.
Yeah.
2022 should be pretty nice too, from a stock market standpoint and market as a whole. So we'll continue to keep an eye on that. Rocky talked about opportunities out there. The reality is, relative to opportunities, the market's always going to give you opportunities, whether it's opportunities to gain more in markets, or opportunities when markets come down to do things like Roth conversions. Basically, you're converting either more money, but you're doing it at a discounted stock market rate and able to bounce right back up. And that all comes back tax-free. So it's all about strategies when you're looking at the overall portfolios, whether it's investing or the advanced strategies, to really kind of eke out more net return for the client.
Yep. So we're constantly managing that.
Well, yeah, I say it all the time. We're a tactical firm in everything that we do, whether it's investing in the market, whether it's tax planning, estate planning, risk management. Think of it like a 3-level chess game, or in this case, a 4-level chess game. You're always having to watch what the other side is doing to move things around, and then adjust accordingly and very tactically to gain a much better long-term net rate of return for yourself. So that's really what we're looking at. So let's kind of round this thing up. And let's talk a little bit about the opportunities. I mean, I said a little bit about it already, but from a planning standpoint, if the market goes up, if the market sells off, is it that big a deal? No, the market's going to do that. It's only a problem if you don't have a plan, and we always have a plan. This chart here, and this kind of wraps up the reason diversification is important, especially if you don't like a lot of volatility. This is a diversification chart. What it shows you is multiple asset class, from growth at the top to international dividends on the bottom when you're looking at the right-hand side of this chart. When you look at the maze there of different colors, you really don't see any kind of consistency. But the way this chart works, it says that the sectors that have done the best rise to the top in any given year, and the sectors that do the worst go to the bottom from a return standpoint. And again, as you can see, there's not a lot of reason and rhyme sometimes as to which portfolio or which sectors are going to do well one year. You certainly can't look at the previous year and say, well, you know what, in 2018, the growth stocks did well, so I'm going to jump into that. Well, what happened in 12 of 2018? Well, it dropped down to negative 15%, almost negative 16. And then it bounced back up again. So you can't jump from area to area, but you can be strategic. Now, the other thing that you're looking at with this chart, again, the growth chart has that dark red line, and you can see the volatility in returns from one year to the other. But going back to that global portfolio, that's blend of 60-40, 60 equities, 40 bonds, and that's represented by the thin red line, you can see there's a lot more stability there. So if you're a high risk taker, we might get you more aggressive. You might have more growth, and that would create more volatility. But if your risk level is low, you really need to be more globally invested and have bonds associated with it to kind of smooth the ride out a little bit.